An equated monthly installment, or EMI, is the fixed payment amount made by a borrower to a lender at a specified date each month. EMI is a common way to pay off loans like mortgages, car loans, or personal loans over a set period of time. Every single payment consists of two parts: the principal balance and the interest cost. This ensures the debt is fully paid by the end. Because the payment is fixed, it makes budgeting easy. However, remember that early in the loan, more of your money goes toward interest. An EMI loan is designed to pay off your debt, unlike interest-only options where you only cover the cost of borrowing. Early on, a large portion of your EMI covers interest. As the years pass, more of that same payment goes toward paying down principal. It is a trade-off. Extending your loan term makes monthly payments cheaper, but you will pay significantly more in total interest to the bank. Understanding EMIs helps you manage your cash flow effectively. If this helped you, subscribe for more simple money explanations.